Donald Trump's second term in office has been marred by controversies. One of the biggest concerns is the suspicion that insider trading may be happening shortly before Trump makes major announcements. There have been several cases where traders have placed bets worth millions of dollars just before Trump made major announcements. This has raised suspicion because there seems to be a consistent pattern. Spikes in trading volume sometimes happen just minutes before his social media posts or media interviews become public. Now, one thing to remember here is that insider trading is a serious offense. It is illegal in the US. For example, you may remember Rajat Gupta, the former CEO of McKinsey & Company. He was found guilty by a federal jury for leaking insider information to hedge fund managers, and he went to jail for it. So US regulators do not take this offense lightly. However, there are still other ways that CEOs with insider information can make huge amounts of money at the expense of ordinary investors and shareholders. And today, I'm going to discuss one of those ways. Hi, I'm Sumit Malik, and welcome to Devil Wears Data, where I share interesting and important research for you. In this series on CEO hypocrisy, I'm looking at CEO behaviors that are hypocritical. Today, I'm discussing another loophole in the regulation that CEOs exploit to increase their wealth at the expense of shareholders. To understand this behavior, we first need to understand how stock options work. A stock option is a contract that gives someone the right to buy a firm stock at a future date. The price at which they can buy the stock is called the strike price. Now, this strike price is usually decided on the day the options are granted to the CEO. Earlier, firms could decide later what the strike price of the options would be. Now, you can imagine this practice would be highly problematic. That was why Sarbanes-Oxley made this practice of backdating options illegal. So we need to understand how this option mechanism works. Imagine I'm the CEO and I'm given stock options with a strike price of $100. Now, if the firm's share price goes up to $120 tomorrow, I'm in the money with my options. That means I can exercise my option, buy the shares at 100 and sell them at the market price of 120. So I make a good $20 profit per share. But the opposite can also happen. Let's say the share price tomorrow falls to $80. Now, in that case, I still have the option to buy the share at the strike price of 100. But why would I do that? Because I can sell it only for $100, that would mean a loss of $20 per share. So in that case, I simply do not exercise my options. That's why the strike price of option grants matters so much. Before Sarbanes-Oxley Act, backdating was one way CEOs could manipulate their wealth. They could choose a past date when the company's share price was very low and use that as the strike price. Now, a lower strike price meant their stock options are more valuable. Sarbanes-Oxley Act made this illegal. But CEOs found a new loophole. They know when their options will be granted. Usually, option grants follow a schedule that the firm repeats every year. So CEOs know the grant date in advance, and what do they do with that information? According to this research, CEOs strategically release negative information about their own firms in the days just before their options are granted. A lot of this information comes from mandatory disclosures. These are disclosures the company has to make public, but the timing of those disclosures can still be strategic, and regulators may not know what information the CEO is holding internally. So just before the option grant day, CEO released negative information about their own company. This signals to the shareholders or the prospective shareholders of the company that something may be going wrong with this firm. They react, they punish the stock, they sell their shares, or they reallocate their portfolios. As a result, the firm's share price goes down. And that lowers the strike price of the CEO's stock options. Then later, when the market has diagnosed the news and when new information comes out showing that the firm is not doing as badly as the CEO's earlier disclosure suggested, the stock price recovers. At that point, the CEO is in the money much sooner. So that is the mechanism this research identifies. CEOs are gaming the system by strategically timing negative disclosures before their stock options are granted. Now, this opportunistic behavior by CEOs raises a couple of questions. This study finds that CEOs are acting against the interests of investors and shareholders. But one possible argument is this. Yes, stock market participation in the US is broad, but stock ownership is still highly concentrated. More than 60% of adults in the US own stocks. But for many people, this ownership is small. It usually happens through retirement plans such as the 401ks. The richest own more than half of all the stocks in the US, the richest 1%. So you might say, hold on a minute, this may be adversely affecting only a small part of the population, like the 1% of the population that owns 50% of the stocks in the US. Most people are not dependent on owning stocks in these companies. They are dependent on jobs in these companies. And this is a fair question. In the next episode, I will share research showing that CEOs also act against the interest of their employees when it helps them maximize their option wealth.